So I'm going to try and make or keep this as simple as I can. And again, anybody has any questions, feel free to ask. So a limited liability partnership, for all intents and purposes, is the same as a standard partnership, but you've got the added benefit of limited liability. The only major difference, I guess, is that with a standard partnership, nobody knows what you're up to apart from you, your partners, your accountant and HMRC. With a limited liability partnership, some of your information is available at company's house. So you've got the additional exposure which some people don't like to have. So apart from that, Rupert, LLPs are the same as a standard partnership. And if my memory serves me correctly, LLPs were introduced in 2001 and were mainly used at the time by accountants and lawyers, but have now become more common. I think they are used as well as they should do by most accountants, just because I think accountants have either shied away from grasping how they work, or perhaps some of them think they're not appropriate when they are. So as the name suggests, there has to be two or more entities. So it can be two people, or two or more people. Or Rupert, I could set up a limited liability partnership with myself and a limited company. That is what's known as a mixed partnership, or having a corporate partner. So as long as there's two or more entities, you can have a limited liability partnership. If you go into partnership with a limited company, have a mixed partnership, then there are certain rules that people need to be aware of. And I think that the tax rules changed in 2014, 2015 in terms of how you can distribute profits. So people do need to be careful, because unfortunately at the time certain tax advisors were using the tax rules slightly aggressively, so the government changed the rules. But an LLP is transparent for tax purposes. So Rupert, if you and I are both partners in an LLP, and the LLP makes £100,000 in profit, and if you and I own 50% each of the LLP, we would be assessable on half the profit each. However, the beauty of an LLP, just like a normal partnership, is this. One year you might say, Shaz, we've made a 100 grand profit, I need £70,000. Can I take the extra cash this year, and next year or in a subsequent year you can then make up for the additional 20,000 I've taken. So we can change the profit share ratio, which doesn't have to be in line with our capital ratio. So if you have a limited company and you and I own 50% of the shares each, we have to take our dividends in line with our shareholding, unless we have alphabet shares or A, B, C, D shares. But if we've just got ordinary shares, we both should take our dividends in proportion to our shareholding. An LLP or a partnership is not limited or restricted to that, whereas the partners can change the amount of profit upon agreement, which doesn't have to be in line with their ownership of that particular entity. So that's something to bear in mind. Of course, the limited liability ring fencing gives people a lot of confidence and security and certainty, so people like it for that particular reason. Certain people, because they like the limited liability, they want that, but they don't like having a limited company, because you've got all the additional rigmarole of company law that they have to follow. So again, an LLP works well. And then things like that, you don't have any benefits in kind. So if you and I had a limited company and we both wanted a car each, which we use personally, which we take home every night, and there's personal use, we'll then have to pay company car tax and file a P11D. But with an LLP, because we are the business to some extent, There's no benefit in kind, there's no P11D to file. All you and I will do is we'll work out how much of the car we use for personal purposes and how much of the car we use for business purposes, and at the end of the year when we're filing our tax returns, we just make an adjustment for personal use, and the rest of the expenditure we claim through the LLP. So it's just like a partnership, but it has limited liability attached to it, so it's a very useful tool. But so if somebody doesn't have capital allowances or anything else to write off their profits against, and they're making sizable profits, or they're making a profit in a limited liability partnership, or a sole trader or a normal partnership, you'll have to pay tax, personal income tax, on all of the profits, whether or not you take the money out or not. Because remember, all of those three structures, you are the business, or you are part of the business, therefore the profits are taxable and assessable on you in that particular tax year. Whereas, as you've said, Rupert, if you run a limited company, the company only ever pays corporation tax, and if any of the shareholders don't take any dividends, there's no additional income tax to pay. So if the aim is to recycle as much of the profits as they can, then a limited company would be a better route, for example. If the aim is to reduce the tax liability, but there are additional allowances available, and the partners or the owners want access to some of the cash, then a limited liability partnership may well be a very tax efficient structure.